Hey everybody, welcome to this week's podcast. And in this week's podcast, I get the opportunity to interview one of my very first friends that I ever met in the multifamily business. His name is Vern Schmidt. He's got a great story. Now, Vern and I met actually through the banker that I used for my first deal. Vern was also doing multifamily deals in the same area. And the banker thought, hey, the two of you guys should get together. So Vern and I had lunch together. We've been fast friends ever since. So let me give you a little bit of background on Vern. He started off as an engineer with AMC, American Motor Cars, back when they still existed. And he received a bonus in the form of stock options. And because of the sale of American AMC to Chrysler, his stock options became worthless. But in their infinite wisdom, the federal government still taxed them at the full value. So Vern got nothing, yet he had to pay out this huge tax bill. Well, that only happened once to Vern. And what he ended up doing is he is the only guy I know that has actually read the entire IRS tax manual and knows it better than anyone I've ever met before. It's like what they teach you in law school. When your client is up against it and you've got nowhere else to go, read the law. I get some great stories of that. Now, that's probably a time for another podcast. But Vern understands the tax and ramifications of everything. And in this particular video, what we're going to be talking about are opportunity zones, which he's got figured out beyond anyone else. And it's another just great conversation with a good friend of mine. So sit back, enjoy the podcast, and I look forward to seeing what you think. Make sure you leave a comment. Thanks. All right, I am here with my good friend, old friend, a guy that I met when I first got started in the multifamily business, Mr. I say Vern Schmidt, but it's actually, let me give you the official name. It's Vern Schmidt. And yes, folks, his name is Laverne, and that's just, it's like, as a matter of fact, Vern, I got to tell you a story. I told my wife that I was talking to her. She goes, "Oh, tell Vern I said hello." She goes, I remember a story about Vern's mother. And I said, "Oh, okay, I got to hear this one." Do you remember this? You know where I'm going with this?
I think so.
About a particular song that your mother used to say?
No.
Oh, but the song, A Boy Named Sue.
Yes, I remember that.
Okay. Your mother said, "Hey, look on the bright side. You could have been named Sue." Purpose of this particular podcast is we're going to talk to Vern about his new expertise, which is opportunity zones. Okay, so we'll get to that. Now, I mean, that's the whole purpose of why we're talking about you. But I want you all to get a background on Vern because he's got a great story, and I'd like to get him all riled up to tell the story by saying, "Hey, Vern, tell us on air in front of thousands of people how you haven't paid taxes in 25 years."
Well, it all started with a takeover of my company. Not my company I worked for. It was American Motors Jeep at the time. And we were acquired by...
That was your Lee Iacocca days, wasn't it? Or
Yeah, it was.
Yeah, it was. Okay.
Unbeknownst to me, my stock options I had, because I was an executive engineer at American Motors doing plant launches and that, my stock options had to be repriced. And so I thought, well, this is great. I get a nice little windfall. And it was a couple $100,000 in profits, but I never received those because the options not only had to be repriced, they had to be extended an additional 5 years.
Okay, so let me just say this. If you had a stock option with AMC for $1, did Chrysler buy them?
Yes, Chrysler bought American Motors.
And so those stocks had to be repriced into Chrysler stock.
That's correct.
And they said, okay, they're not worth $1. They're actually worth what, $4 or?
Well, they were worth $5.
Okay, so now they're worth $5. So you did have a windfall. I mean, you must have gone home thinking like, look at honey, we're worth 400% more than we were before.
That's correct.
Okay, good for you. So you were buying the drinks that way.
That's what I'm thinking. Great, this is in November, and then come I guess it was April. I got a little notice in the mail that I had owed $200,000 in income. I'm thinking, wait a minute, I didn't get $200,000.
Okay, but wait a minute. You said something. You said something before that I think I kind of glossed over. The options had to be extended, meaning you couldn't option those stocks. You couldn't buy those stocks
No.
until how many?
I had they were grants. I could not at American Motors. I was just about ready to sell them. They were ripe. They were ready to be sold. Now I've got new options at a higher price, but I can't exercise those for 5 years.
And you got a tax bill because of that windfall
Yes,
that you can't realize.
that's right. It's called phantom income.
Well, did you pay the taxes with phantom income?
I wished I could. No, I had to use real dollars, and
Isn't that unbelievable?
frustrating because at the time I probably made a little more than what the option tax price was. In other words, I think I made I had to pay 80 grand in taxes, and I was making maybe 100 grand at the time. So it kind of hurt a little bit.
Yeah. How do you you had to borrow the money to pay that?
Pretty much, yeah. That's right.
Unbelievable.
I mean, I was a saver at the time, so it hurt because you don't normally have a year's worth of salary saved up. You can just pay something on
Right.
it. But that got me started because I was not an accountant. I wasn't a CPA. I'm still not. I'm an engineer. I had 200 people working for me, 125 engineers, and I was also in charge of quality control at the assembly plants at Jeep and, well, all over the Chrysler landscape in the Midwest. But it was frustrating at the time.
Yeah. But it opened your eyes.
It did. I mean, I'd been doing my wife's taxes. She was a real estate agent since we got married in '76. She got her real estate license the year she got out of high school. So she'd been a realtor for a long time. But I figured I might as well understand the tax law. I'd been doing it for probably 20 years. And so I dug into phantom income and phantom losses. Kind of jumped out at me as just because you got phantom income, which is what you don't like to have, you can have phantom losses to offset not phantom income, but any income if you can structure it right as a real estate professional. And
now, those are also called NOLs.
Net operating losses. That's what the phantom losses generate.
Okay.
It's net operating loss.
Yeah. I know those well. I know those well. Right?
Yeah. Up until last year, you could take net operating losses and go back 2 years and get any taxes you would have paid directly refunded to you. But they've since changed the tax law with the new Tax Cut and Jobs Act. You can only take them forward now, and they're limited to 80% of your income. So the most you can offset now is 80% of your income.
Okay, I'm going to have to dig into that one a little bit. So we'll see, yeah. Mr. Trump. Maybe I won't be voting for Mr. Trump next time around because of the new tax law. Well, he already had me move out of Massachusetts, which I thank him for that. But
where are you now?
I'm in New Hampshire.
Oh, I didn't know that.
I gave myself a 6.5% raise.
Wow, you ought to give yourself a 0% raise. Move to Florida where there's no taxes.
Well, there are no taxes up here. The property taxes here. I own a condo up here in New Hampshire, but and it's small compared to my house down in Duxbury. But I know they're going to get you any way they can, Vern. I mean, you're right. Florida is the place to go. I mean, Tony Robbins did that whole book on money. Great book on money and how to invest. And he said that he was a Southern California boy. And with the last tax increases, he said, I am paying more in taxes than I make. He says he was paying close to 60% of his income out in taxes. And he said, they just told me to leave. They told me they didn't want me anymore in Southern California by just increasing the taxes. So he looked around the whole country, and he really looked around the whole country as to where he should move to get out of paying taxes or, to reduce his tax liability. And where do you think he ended up? Florida. He said I never want to live in Florida, but when I did the math, he said it was the only place I could live was Florida. So he gave himself. So he paid cash for it. Got a big, beautiful place right on the intercoastal, and he said within 6 years, what I save in taxes will have paid for this whole entire thing. So
that's correct, and also they have a big homestead. You can exempt the entire price of your homestead from legal claim.
Liability.
That's what O.J. Simpson did, not to, That's the right thing. But
See, another tax scofflaw. All you guys are down there. See, I love how you just put yourself in the same category as O.J. Simpson. That's beautiful.
well, if it fits, you must have quit.
and Vern, that glove fits you like a glove, I guess. So that's beautiful. Oh man. So all right. Now you know, fast forward. Now you're in the you decide that you're getting out. No, well let's talk about your real estate career and how you know what you ultimately done is you built up your real estate business to get out of the car business.
That's
so
correct.
How did you do all that? Tell me your whole real estate experience process.
Well, when we first got married, way back when in the 80s, 70s, I think my wife bought our first house with cash, and I loaned her $1,000 for it and gave her a promissory note to love, cherish, and adore her, and if we ever got married, I wouldn't have to repay it back. So I made good on that promise.
Yeah, she's thinking she should have cashed that out. She should have called that note.
No, she's a wonderful woman. We rented it out before we got married, and it was a typical, we didn't know anything about real estate, even though she's a realtor. Renting property is different than just having the cash come in every month and not have issues. The tenants ended up owing us money. The neighbors had told us they had kept a monkey in the house, which didn't surprise us once we saw it. And they left the back door wide open in January with no fuel oil in the tank, so the furnace was running. I just happened to drive by the house that day and see the door open. That's how we knew the renters left. That was our first experience. So we shied away from it for 20 years after that.
What town was that in?
That was in Lambertville, Michigan.
Lambertville, Michigan. Okay.
Not well.
Yeah.
Where your apartments were.
Well, we didn't call it Lambertville. We call it Temperance.
It's the same thing.
Wow, you were in my whole town. You and I bought our first properties in the same town. Isn't that wonderful? Isn't that amazing? And of all the gin joints in all the countries around the world, you and I choose Lambertville to start our multifamily, our investment career. That's great. Oh, that's cool.
But at any rate,
yes.
Then is that as I was working at Chrysler, I was moved down to the Toledo assembly plant to launch a new vehicle and take care of the quality down there with the engineering liaison back north. And there's a requirement that if you move and the move is more than 60 miles, you can be compensated with a relocation package. And depending upon how you routed traffic, I qualified for relocation package, not coming down, but on the way back north. So I had never moved my house. I didn't want to move my kids and change school districts, when they were in their teenage years. So I just stayed there and commuted. But when I went back, I now qualified for a relocation package, which meant they could buy a house for me and give me the 20% down payment. So all I had to do was make the loan payments each month and the house was mine. And that sounded like a pretty good deal because that amounted to probably $25,000.
Now, wait a minute. How is it possible that in one direction it's less than 60 miles and in the other direction it's more than 60 miles?
Because it doesn't go from where your workplace is, it goes from where your home is. So when I went to Detroit, it was a 60-mile drive back there. Okay, I qualified, but since I drove there anyway, that didn't matter. But since I now was living and working in Toledo, now I qualified. It was more than 60 miles to go back to Detroit. It goes by how far you're driving from where you are currently. So
all right.
It's high math. I know, Charlie.
This might be why the company's out of business now, Vern. Might be the real reason. So
now that was an IRS regulation.
Oh, all right. Oh, okay.
But it was beneficial because what that allowed us to do is my wife was a realtor time and she was on an open house and she just happened to go down into Luna Pier, which is right on the lake there at Lake Erie, and she saw this dumpy little 3-bedroom house, but up on the second floor, you look out these little 3-foot by 1-foot windows at this gorgeous view of Lake Erie. And she just fell in love with it. Matter of fact, they had to drag her out of the house to get her back in to finish the rest of the tour. So we had a vision for that house because it it was owned by an elderly lady, Mrs. Waterfield, and she'd lived there for 50 years and ended up moving into a retirement home. So we took over it, took care of it. We knocked out the back wall of the home and put a window wall in, 18-foot window wall and a 2-story deck such that you could actually see the lake. And we used that as when I had to go to Detroit, I would stay there overnight since it got about 15 miles off of my commute. Oh, and I should tell you that I didn't have to sell my other house. I kept the other house.
The Lambertville house?
Yeah, it wasn't a requirement that I sell the house. I could just buy a new house. I didn't have to sell my first home. So that started my empire. What came along with that house was a second house, a little cottage. You know, it was more or less a fishing camp. You pulled a rope to get the ladder down to go up into the sleeping loft. And it didn't have a furnace, so it was really only used in the summer. But we turned that into a rental, and then we bought the house 2 doors down. And I had just met Albert Ayala at the time, who's now since passed, but he was a tax guy that specialized in cost segregation and the forest trees method of figuring out what you can depreciate on a property.
Yeah.
And what he taught me was that buying a rundown house, putting repairs into it, you could not only deduct the cost of the repairs, you could deduct the depreciation that was unused. So you could double or even triple your depreciation costs sometimes. And what that allowed me to do was to fully depreciate 3 homes, and then with the tax checks I got back, I could pay cash for another home. It was about $100,000 on the lake, about a street over. So
Wow.
it's buy 3, get 1 free, you know?
Okay, so let me see if I can have this straight. You're working you're a W-2 employee.
Yep.
They're taking taxes out of your paycheck every month. So you got a guy sitting right next to you who's doing the same thing. You guys are the same amount of money. You both are W-2 employees, but you are buying real estate, and you know all the rules. You know the accelerated depreciation or double depreciation, triple depreciation, and so all the money that they're taking out of your paycheck, you're going to be getting back because of the real estate.
Not only that, I got the money back that I paid 5 years previous and 4 years previous and 3 years previous. I got 5 years worth of taxes back as a refund.
Wow.
So there was a stretch of time I didn't pay taxes for probably 15 years because, and the reason this worked is my wife was a realtor. She automatically qualified as a real estate professional.
Okay. That is
all your losses can be offset against any income you have.
All right. So the guy sitting next to you, if his wife wasn't a realtor, he wouldn't even have these options available to him.
That's correct.
It's just being in the real estate business for more than 50% of your time. Okay. Wow. That is, yeah. Isn't that amazing? Wow. Oh.
The funny thing is a lot of people don't realize it, but you can go back and do your depreciation 5 years. If you're just using standard depreciation, you could go back and change that, do a change of accounting method, file form 3115, accelerate depreciation, and you could get all that depreciation caught up right now. It's as if you took all of it in 1 year.
Wow.
But you just have to be able to use it.
Yeah.
If it's lost on you if you're not a real estate professional because you're limited to 25,000 passive activity losses.
Yeah. Gosh. All right. So this is how Vern Schmidt has not paid taxes in a million years, everyone. Just so you know, the man is a tax scofflaw. He's, but the beautiful thing about it is he's out in the open about it. And that's, he thumbs his nose to the IRS and they can't touch him. They cannot touch him. All right. Hey, Vern, let's get into why you're here today, because you have now formed a new, and also I'm gonna let you give your plug about, what you do for people. I know, you did that to my owner forum group. And but let's get into the new expertise of Vern Schmidt, thanks to Donald Trump. Actually, no. Boy, I take that back. This is not, I would say again.
It was Donald Trump who signed it, but it was actually the, I've forgotten his name now, but he was a big Democratic sponsor fighting for capital gains tax relief. Was
it Steiny or was it that big?
One of the big PayPal guys.
Yeah, wasn't he out in California? California
yes.
guy?
Yes.
Tom Steiner. Tom Steiner?
Well, I can Google it if you give me a minute here.
Well, yeah, but anyway, okay. So he's a big liberal, and he created this whole concept about opportunity zones. Okay, so Vern, give us give us a 30,000-foot view. Give us a little historical background on opportunity zones and what they're all about.
Part of the Tax Cuts and Jobs Act was establishing opportunity zones, which the governors of each state could establish what areas they wanted to improve with capital investment for the next 15, 20, 30, 40 years to encourage people to move in and redevelop, regentrify areas that were depressed. And the way they did this was through using the census tracts to determine what level of poverty was in the area, what level of median income was in the area, and determine if that was a zone that needed improvement or had opportunities for improvement.
Okay, so it wasn't like a governor could just walk in and say, hey, my whole state is an opportunity zone. They had to meet particular criteria?
That is correct.
Okay.
And if you if you just Google Opportunity Zone US, you can see all of the websites, although I'd recommend you do Opportunity Zone and then your particular state. You can see what zones on a map are your opportunity zones. And I think there are somewhere in the neighborhood of, it's either 4,800 or 48,000 opportunity zones. It's a big number. And surprise upon surprise, pretty much my whole county where I am in Florida is an opportunity zone. So I can invest right down the street here, and I could use opportunity zone funding if I so choose.
All right, so let's use that as an example. Let's use your local county because okay, wait a minute. You just kind of told us that you just bought this office condo that you're in.
Yeah.
Is this like, did you take advantage of some special deal because of it's in an opportunity zone?
Oh, no, I didn't know about it. I bought it a year and a half ago. So
okay.
It was just a good deal. We paid $60,000 for the condo. I put 25 into it because the roof leaked, the drywall had fallen down, and it just hadn't been lived in for a long time. But it's now worth probably 140, something like that. So,
folks, this is how the rich just keep getting richer. Okay.
But it's also my office, but I won't get into that because my S corp actually rents it from me. So.
Okay.
But that's a tax-free reimbursement. So that's another podcast on how you use S corps to eliminate more taxes.
Oh my gosh! All right, so let's use your county as an example. So the governor of Florida has said this little old county is so bad. That right now, as it stands, Vern Schmidt is in the top 1% of the top 1% of all income earners in our county, and this little scofflaw doesn't even pay taxes on that money, and so that's why our county is so bad that we are now declaring it an opportunity zone. So the first thing that Vern does is he says, "Okay, I'm going to make more money in this county," and so what do you do? What do you do, Vern?
Well, the only way you can take advantage of this is if you have capital gains. So you can't just invest money, your own money into it that you've saved. You have to have had the stock that you sold or a house that you sold or a boat or a car, something that you generate capital gains. You can invest all those capital gains. You don't have to invest your original amount of money that you paid for the place, but just your gains. You can then buy a particular rundown home, or you can build a new one, and that will qualify as an opportunity zone property.
Okay, so if somebody decides, because I have a lot of clients here at our insurance agency who come in and hey, we just sold a bunch of stock, in preparation for retirement, and so they end up they have a huge gain that particular year, $50,000. And what you're saying is they can now take that gain, whatever they earn, and they can turn around in your county and buy real estate that exists there, just any type of real estate. Do they have to, like a 1031 exchange, do they have to do it in a particular entity, or can they own it in any way, shape, manner, or form?
You can only own it through a multi-member LLC.
Okay. Oh, really? Only an LLC?
It can't be a single person. It can be two people. It could be a husband and a wife, or it could be a group of partners that would invest in this.
Okay. But it has to be an LLC, really? It can't be an S corp or a
Well, S corp wouldn't give you much in the way of tax benefits because
C corp. Then okay.
incorporations are double taxation. So LLC pretty much sets it up the way you need it. And it's
Okay.
pretty specific about that.
Okay, but it doesn't matter what like with a 1031, it doesn't matter what form it's coming from and going into. If the person sells stock, realizes a gain, they can turn around and buy into an LLC, multiple member LLC, and they're good to go.
That is correct. It is not a like kind exchange. It is any capital gain into real estate.
Okay, and so what is the benefit that they're realizing because of this opportunity zone?
Well, the benefit is if you hold it long enough, you don't pay any capital gains tax.
On the back end, so like when you finally sell this property and the LLC dissolves and everything gets distributed and you make a ton of dough.
Let me explain it this way.
Go ahead.
I just was instrumental in putting a deal together for an investor in Indianapolis who does medical student housing. Builds and renovates 4-bedroom, 3-bath townhouses, granite countertops, just beautiful homes that he's renting for between $2,800 and $3,600 a month. And he's renting them to medical students who are in their second and third year of internship before they become doctors. So they're putting in $500,000 to build these brand new. And it's important to distinguish here. There are two types of product you can invest in an opportunity zone. One is you can buy a rundown property and put 50% of what or you can build brand new and have a property that's never been lived in before. So if you bought a property for $100,000, the land's worth say 20, you're net into it for 80, you got to put another 40 into that property. So you'd be into it for $140,000.
Okay.
That's what you'd have to do. Brand new, you just build it and you're good to go. But just say for that instance, on the $100,000 that you're buying this property for, actually, let me use the $500,000 because those numbers are fresh in my head. If you're buying a property for $500,000, you have tests you have to meet every 6 months to make sure you're investing the capital. And you've got 3 years to complete the project. Otherwise, you'll end up shooting yourself in the foot and you'll have to pay capital gains tax immediately if you fall out. You'll have to pay penalties because you violated the tenets of the agreement. But so on this, let's just go back to the $500,000 condo or house that you're building in this Midwest city. On $500,000, they would have paid 20% on the tax on it, so it's about $100,000 or so. They'd have to pay in tax right up front. They can defer paying that. If they sold the stuff now, they'd have to pay that $100,000 in capital gains. If you invest in an opportunity zone, you don't pay that. You defer paying that for 10 years.
Which is unlike Vern Schmidt back in the AMC days, where he had to go back and, once he had that depreciation, to go back and collect it every so often. Here now, when you have that investment and the tax bill comes in for $100,000, you can say, well, no, we put our money into this opportunity zone. We haven't made any money in it yet, but we're not going to pay you any taxes on it. That's
right. What you do, it's kind of like double dipping, and I'll get to that in a minute. But what you do is you're deferring paying the capital gains tax now. If you hold it 5 years, they give you, I think it's, I want to say 5% off. If you hold it 7.5 years, it's another 10%. Maybe it's 10% of the first one, 5% the second. But after 10 years, if you hold it, all capital gains are deferred. So you won't pay the capital gains tax on that. And if you sell it, they will step up your basis to the current market value. So if it appreciated another $100,000, which is not unlikely, you would also then have had to pay another $20,000 in taxes when you sold it.
Okay. Now, wait, hold on. You say 10 years. 10 years. If you sold this thing in 9 years, you don't get that benefit. It has to be.
You get the deferment of 15%.
Okay. All right.
10 plus the 5.
Okay. Wow. Okay. And
this is for okay. I'm flabbergasted here because I'm trying to wonder why we haven't heard more about this. Why, when people are looking to buy property, they're not really, touting the benefits of a particular opportunity zone for investors. Obviously, the property has to be in that particular area. So let's, how has this opportunity zone law affected your county? Have you seen things change in there, or is it just people just don't know about it?
Well, you haven't seen it change yet because they haven't issued the final regulations. We don't know exactly how and when they're going to penalize you if you do things wrong and what the final reporting rules are going to be. There's a tentative.
People are leery about this.
Yeah, there's a tentative document out there that you attach to your tax return every year to make sure you keep your opportunity zone fund intact.
That's funny, because I attach a tentative check to my tax return every year, and we'll keep our fingers crossed if it clears. So yeah, that's interesting. So they can give tentative forms, and I give tentative checks. Just works the same way. Gotta love the IRS.
You ought to be using me for your taxes.
No, actually, I want you to take a look at my taxes this year because I seriously do have a big issue. And I tell people.
Yeah, you pay money.
I pay a lot of freaking money. Oh my gosh.
Well, you're one of those 1/10 of percenters right now, believe it or not.
I know. I should be a Democrat. I make so much money I can afford to be a Democrat now.
I'm surprised you're not out there in the liberal East Coast.
Oh, are you kidding me? I told you I got out of Massachusetts, but remember, I moved up here to New Hampshire. New Hampshire's becoming a blue state. Oh dear God, we have Democrat everybody up here. It's not the state I grew up in. That's for darn sure. It's not the land of Bill Loeb of the union leader anymore. That's for sure. Oh my gosh. So, all right. So what? So obviously this condo.
That just sets the stage for the next part. That just says, okay, you don't pay any tax on the capital gains. You still get your depreciation, any cash flow this might generate through the 10 years. So, depending upon if you need to do accelerated depreciation and you have partners that can use that depreciation,
okay,
you could accelerate that and get another, I want to say, using accelerated depreciation, you get 30% the first year, maybe 20% the second. So you could save another $250,000, another $120,000 in taxes if you worked it right.
So you're giving the IRS a double whammy. You're hitting them with a double whammy using their own rules.
I'm using phantom losses to my advantage now.
Yeah.
They should have never done that to me because they opened up a monster, man.
They did. They absolutely did. They opened up a little cottage industry down there up in Michigan and in Florida, a guy that's going to teach everybody how to screw the IRS over with their own rules. And that's the way. That's how everybody wins. When you know the rules better than the other guy, you can win the game. So, hey, let me ask you this, Vern, because let's lay this one out for people listening on the podcast. You're putting together a deal, and you're the sponsor. You create an LLC. The LLC documents and the operating agreement talk about depreciation and how depreciation is going to be used. How can the operating agreement be written in such a way that little old me, just getting started, I don't have any real need for the depreciation, but I could rewrite the operating agreement to give some of my investors that depreciation if it would benefit them more. Therefore, it will essentially drive up their the benefit to being in my investment. How do we do that?
Well, I'm not a lawyer, so I can't give you legal advice, but I can give you an educational snippet of how you might do that.
Yeah, well, don't worry. As a lawyer, all I'm going to do is listen to what you say, and then I'm just going to write the document. So go ahead.
There's a little-known code in the tax law about distributed allocation of losses. And what that says is that LLCs, and pretty much only LLCs, can allocate losses, profits, or capital interest in any way they so choose, as long as there's a business interest. So one of the things I found in using these is that over the years, you don't really want to take take it to the extreme. In other words, you don't want to take all the losses, because at some point in time, you will have used up losses in excess of your basis, then you start paying tax on that. What I've found is if you can allocate somewhere over 30 to 50% of the losses to one section of members, and then go back to capital allocations after that, say for instance, because you're the syndicator, and you'd like to have some capital or cash flow in the early part, and then you can revert to capital losses. So you're trading your cash flow for losses you don't really need and giving that to your partners. That's a relationship that would stand the test of time. And as you go forward, things will start evening out in years 5, 6, 7, 8, 9, and 10 if you hold the investment that long.
Okay, so early on, I can entice people into my deal by allocating my losses to them, and until for the first 5 years or so.
Yeah, and it's they have to be able to use them. In other words, if you give them $100,000 in losses, but they're passively loss limited to 25, it does them no good. That just goes into abeyance until they sell the property.
Okay. All right. So let's get back to opportunity zones. I just took that little, road less traveled there. That's another New Hampshire guy, by the way. You know that? Robert Frost, right down the street in Derry.
Oh,
Gosh,
yeah.
all the great minds are here in New Hampshire.
Save one.
Save one. Did you say save one? That's such an old expression. Save one. I'm 72 and Vern is 102. Okay. So Vern actually knew Bob Frost. You used to call him Bob Frost back in the day. All right. So how can, let's wrap this up, because boy, this has been a long call. This has been a very fun call. How do you recommend a new investor take advantage of opportunity zones when they're out there looking for deals? And then also when they're pitching their deals as well?
They're probably not going to be able to pitch them until the final regs come out, and that kind of got
because the SEC would be all over them for giving out bad information.
Right. That's right, and you're familiar with the SEC, and these things are probably touted as securities, so you got to watch what you're doing.
Yep.
If you're moving money across state lines, you got to have a Reg D, and you just have to follow all those same criteria that most syndicators are aware of.
Yep.
So, until the rules are finally set, and they were torpedoed because Trump shut the government down in January on the day that we were supposed to have the final hearing on rulings and regs, and they haven't reset the date yet. I'm still waiting for the regs to come out so we know how to do it.
And wait, so it's like they're still on vacation.
That's correct.
Oh, nice. Thank you, government. All right. So
it was interesting because I got a couple of IRS audits going on with my clients, and they were supposed to come. This started in September, and they kept dragging it out. They were supposed to meet us January 12th or 13th, and we get calls. Well, I said, tell the government. I shouldn't say tell. He doesn't know that yet. The government shut down. The IRS isn't going to come out today. And sure enough, they wouldn't. And a couple of weeks later, after things came on, they said, well, we will be out when we think we can. There's no more threat of a government shutdown. So I was like, really? So you are going on vacation, IRS, when you could be generating this stuff? And it's interesting that they just now closed the case, and it's been, since last August.
that's interesting, because I have a similar situation going on, and I'm actually surprised that I haven't heard from the IRS in my situation, and that might just explain why.
Sure.
All right, cool.
But
Thank you, Donald Trump. Thank you, Donald Trump.
Until you get some regs out, it's going to be difficult to entice investors to do anything, because you don't know what the final rules and regs are going to be. The only thing we know for certain now is if you sell your investment for a capital gain, you've got 180 days to put it in an opportunity fund. That just means you set up an LLC that is going to be used as an opportunity fund vessel, if you will.
Oh, so it doesn't even have to be, the LLC doesn't even have to have identified property like on a 1031. It can just be an LL. Oh, this is why all of those opportunity zone funds are starting up.
Yes. But see, the clock's ticking, because once you start taking the money, you've got, I think, 31 months to invest that money, or you start paying penalties. So, and that's,
Wow.
as you can see, I think Kathy Fetke, the Real Wealth Network, has kind of pulled back on her fund because she doesn't know what she can do.
Yeah.
So you don't want to, take in more money that you can't do anything with until you know how you can spend it.
Yep. Wow.
I mean, you can spend it, but you don't know if you're going to spend it wisely and if it'll meet the 10-year goals you had set out for you. It's just, it's a crapshoot right now.
Well, that's too bad. That's still typical government, though. So, all right. Hey, listen, we're coming in for a landing here, Vern. I want everybody to know what exactly you do now, how you operate, and how we can get a hold of you.
Best way to get a hold of me, since I'm off the radar, hidden down here in my bunker like Mark Levin.
Oh gosh, I tell you, I'm jealous. I'm so jealous. But I do. I have a similar lifestyle because, as I always say, this little backdrop here. If I drop it, you'll see that I'm actually sitting in a food court in a mall in New Jersey. So nobody knows where I am. So
you can either email me at vern.schmidt@gmail.com or call me on my cell, 419-356-3022. What I do is I do taxes and tax planning for real estate investors. And you typically aren't the people just starting out. You need to have income of somewhere around $200,000 and a spouse that can qualify as a real estate professional. That means you've got
or not just a spouse. It could be them too. So keep that in mind too. Don't.
It could be, but if you got a W-2 job, it's tough to do that.
They could be. Gosh, you're always cutting down the man there, Vern.
Yeah,
the guy could qualify.
I got 1,000 cuts in me from the man. I'm coming back.
No kidding. All right. So so it's a person who high income net worth, high net worth, high income that has
with real estate portfolio.
Yep. And you can do things. And I've heard this. Vern does amazing things to get you your money back from the IRS. If you liked his story about being, how he got into this and how he was able to stop paying taxes because of he actually reads the IRS regs. Gosh, I mean, you're sitting there in front of a ball game and the guy's got his IRS regs book out reading it. It's crazy. He's the only guy I know.
Well, just so you know, I just want to make the disclaimer. I'm an engineer. I was a licensed professional engineer.
Say no more.
I'm also a licensed building contractor and a registered tax return preparer. So those are my qualifications. And I own probably 200 doors of real estate right now.
Yeah. We didn't even get into that. I mean, he does this for fun, folks. He doesn't even have to do this. This is play money for him, getting out there. And he gets more joy than you do in finding out that you're getting a huge refund from the IRS. All right. Hey, Vern, great to see you. Great to talk with you. And, we'll just keep staying in touch. Can't wait to see you.
All right. Thank you, Charlie.
Thanks, man. Talk to you soon.
All right. Bye-bye.
Bye-bye.